History books often focus on the philosophy of liberty, yet the British Empire was hollowing out its own treasury to pay for the 7 Years' War. Victory left London with massive debts, soaring interest payments, and a desperate need to turn its colonies into a revenue stream. The Currency Acts of 1751 and 1764 tightened this grip. Parliament legally banned the colonies from printing their own paper money, forcing all colonial trade and debt to be settled within a British financial system that favored London merchants. This restriction caused a massive economic contraction. Without local currency to facilitate internal trade, credit evaporated and deflation set in. Farmers and merchants found themselves in a financial chokehold, unable to pay British creditors because they literally could not access the currency required to settle their accounts. Financial suffocation made independence a strategic necessity. For the colonial elites, who were deeply indebted to London and pound sterling, breaking away offered a path to reset their balance sheets and reclaim control over their own liquidity. Anger was high, but George Washington's military objectives were constrained by a lack of hard currency. Modern warfare required gunpowder, rifles, and supplies that the Continental Congress could not afford. These overlapping colonial notes are continentals. They represent a desperate attempt by a shadow government to manufacture capital out of thin air, with no gold or silver to back the paper. The formal text on this 1779 bill claims a value of $55, yet as more notes flooded the market, the currency's actual purchasing power collapsed. Soldiers were paid in bills that merchants refused to accept, rendering the American military effort effectively insolvent. Printing unbacked paper only accelerated the decay. Without an outside injection of hard currency, the Continental Congress was on a fast track to total bankruptcy long before the military could secure the field. Britain's enemies recognized that funding a rebellion was far cheaper than launching a direct naval war. France and Spain began opening their wallets, treating the American colonies as a strategic lever to weaken the British Empire. France operated through a shell company called Roderigue Hortelles and Company. This fake commercial front allowed the French government to secretly ship gunpowder, rifles, and gold to the rebels, while maintaining the appearance of neutrality. Spain followed a similar path, laundering silver through Havana. Hard currency, like this 1765 Spanish silver dollar, replaced worthless paper and provided the liquidity needed to keep the Continental Army in the field. These monarchies were pursuing a strategic geopolitical investment. By bankrolling the revolution, they intended to exhaust British resources and reshape the global balance of power without risking their own fleets. In Amsterdam Stock Exchange, Dutch bankers treated American independence as a high-risk financial instrument. They extended credit and bought American bonds, betting on the success of the new nation as a speculative investment. This flow of Dutch credit legitimized the revolution. It transformed a desperate uprising into a viable geopolitical project that global markets could now trade and value. Converting these loans into military fuel required domestic fixers. Men like Haym Salomon and Robert Morris managed the war's ledger, using their personal credit to keep the army solvent when Congress could not provide cash. While generals won battles, these financiers provided the hard currency and administrative plumbing that kept those armies from dissolving due to lack of pay. Independence brought sovereignty, but it also brought a massive debt to Europe. The red wax seals and official signatures on the Treaty of Paris created a formal legal obligation for the new United States to repay its foreign patrons. Under the Articles of Confederation, the federal government had no power to tax and had to beg individual states for funds. Foreign creditors, watching the U.S. default on its interest payments, began to close their wallets, viewing the loose Confederation as a failing investment. This credit crisis forced a radical change in the American government. To secure future loans and maintain international credibility, the new nation needed a centralized system that could guarantee repayment to Amsterdam and Paris. Alexander Hamilton's plan for a national bank and federal taxing authority provided the stability creditors demanded. These were not just policy choices, they were requirements for re-entering the global credit markets. By granting the federal government the supreme power to tax and manage trade, the Constitution transformed a collection of defaulting states into a creditworthy entity. It acted as a restructuring plan for a nation in deep financial arrears, proving that the early American state was shaped by the need to service its debt. The consequences were immediate. To pay back European lenders, the government levied taxes on frontier farmers, triggering the Whiskey Rebellion. The very country born of a tax revolt was now deploying troops to collect taxes for its own creditors. This strategy remains a cornerstone of modern geopolitics. Global powers still finance foreign proxies to destabilize rivals, using money and logistics to shape distant conflicts without declaring direct war. The United States, now a global superpower, began its own life as the insurgency being financed from abroad, its founding made possible by the strategic investments of older empires. Nations rise when financial incentives shift and rivals see strategic profit in their success. The American founding serves as a case study in how capital, credit, and debt can rewire the global balance of power.